Cash vs. Stocks. How to decide. In the years following the 2008 financial crisis, stocks experienced a prolonged bull market, generating positive returns for several years. Those returns were high enough to draw many investors to the equity market. This, coupled with the low interest rates offered on savings accounts, drew more investors towards stocks. However, stock markets have turned downward in 2022, changing the calculation about the relative attractiveness of investing in equities versus keeping money in cash. As the Federal Reserve raises interest rates in an effort to combat inflation, cash becomes more advantageous, as the interest you earn on your cash holdings ticks upward along with the rate increases. At the same time, increased interest rates could slow economic growth or even sink the economy into a recession, raising questions about future stock returns. Let's take a look at some of the important risk factors to consider when investing in cash versus stocks and managing risk optimization. Key takeaways. Stocks had a great run over the past decade, while the rates offered by savings accounts remained dramatically low, drawing investors toward more risky investments in search of yield and returns. However, the calculation has changed in 2022, with interest rate hikes by the Federal Reserve making cash investments more attractive and raising doubts about future stock returns. Investors must consider volatility and current interest rates when deciding how much to invest in cash versus stocks. For investors looking to gain exposure to stocks during periods of market volatility, one advisable strategy is dollar cost averaging key into index funds. Things to remember about stock. The stock market ebbs and flows, with periods of ups and downs, bull runs, and bear slumps. Granted, there have been a lot more ups than downs over recent decades. For instance, the S&P 500 was up about 195 for the 10-year period ending October 9, 2020, or an annualized 11.4 return. However, the stock market bonanza of recent years has not managed to hold strong in 2022. As of October 2022, the benchmark S&P 500 index was down more than 24 year-to-date, with a decline in excess of 24 year-to-date with a decline in excess of 20 indicating that the market has entered bear market territory. 1. As the recent declines in the stock market make clear, it is difficult to predict which way the market will go. Therefore, market timing is ill-advised. Because stock prices have trended upward over the long term, the general advice is that it is more profitable to remain invested in stocks, even in periods of market turmoil, rather than pulling out of those markets entirely. Investors can also allocate money to index funds via dollar cost averaging EAKK instead of keeping cash on the sidelines. Sticking to this strategy when markets are down means acquiring shares at a lower price and increasing the opportunity for gains when markets recover. Even investors will likely be better off over the long term if they avoid overreactions to downturns in the stock market. One of the keys to growing a portfolio is minimizing losses. Market timing with cash and strategic stock purchases can be vital to keeping your losses as low as possible. Key considerations for stock investors. Volatility. Volatility is a key factor when investing in stocks. In other words, how quickly or severely do prices whip around? High volatility can cause investors to panic. Monitoring stock volatility can be more than many investors want to handle on a daily basis. Monetary policy. Monetary policy is another factor to follow. Along with volatility, it can greatly influence the market's investment demand and how investors allocate their money. Setting interest rates low helps to stimulate borrowing, while higher rates cause more investors to save. However, low rates translate into lower rates for savings accounts and fixed income investments. In 2015, the Federal Reserve raised the federal funds rate for the first time in 7 years, finally lifting it to 0.25s from 0. Then the federal funds rate range set by the Fed increased from 0.25 to 0.50 that same year, eventually reaching a level of 2.25, December 25s by December 25s by December 25. However, concerns about the economy during the COVID-19 pandemic caused the central bank to lower rates yet again, with the Fed funds rate dipping back to the 0 to 0.25 range in March 2020. 2. The low interest rate environment maintained by the Fed throughout the peak of the pandemic made stocks an attractive investment compared with keeping money in cash. However, as inflation concerns took center stage in 2022, the Fed began a steady series of rate increases, with the federal funds rate rising to a range of 3 to 3.25 in September 2020. 2. These boosted interest rates have a multifaceted impact on those, considering how much of their portfolio to invest in stock and how much to allocate to cash. Higher rates make cash investments more profitable, as the interest paid on savings account deposits and other cash equivalents increases. Furthermore, the increased rates mean that it is more costly for companies to borrow to fund their expansion and growth, potentially limiting returns for stock investors. Corporate profitability. Corporate profits can transfer directly into stock prices. While companies have generated strong profits for several years, the pandemic may have put some strain on corporate profits. The lingering effects of the pandemic and the additional geopolitical instability related to the war in Ukraine could have a continued impact on corporate profits over the coming quarters and years. A slowdown in the growth of corporate profits could lead to lower stock prices over a longer term. Alternatively, many of the global international companies are also top dividend payers, which affects income investors deciding between stocks and cash as well. Cash vs. stocks. Investors deciding whether to invest in stocks or hold cash will need to keep a close eye on interest rates. One of the downsides of holding cash is that the buying power of your money slowly deteriorates due to inflation. In late October 2022, the rates being paid on savings accounts and treasuries are not keeping pace with high levels of inflation. The 10-year Treasury rate as of Oct. 28, 2022 was 4.23. Meanwhile, the inflation rate for the 12 months ended September 2022, as measured by the Consumer Price Index for all urban consumers, PIU, was 8.24. One of the big issues for cash investors these days is that while interest rates have been moving steadily higher, they remain below elevated inflation rates. That said, below are some additional considerations for cash versus stocks in 2022 and beyond. Are company profits growing or stable? Many investors may consider certain companies to be a great buy because their stock prices have fallen, but buyer beware. The market may not stabilize and improve as fast as some expect. Are the dividends currently being paid stable? Dividends are a large portion of the total return you get on a stock. If a company has a solid dividend, paying history, and a relatively low payout ratio, then you might consider buying it. Are stocks safe to own for the next 5 years, given the current market conditions? In other words, do you have enough conviction in the stock's value or growth prospects to believe in its ability to weather the market's volatility? The amount of money you are willing to invest in cash versus stocks will also be influenced by your risk tolerance and investing goals. Investors who need funds for emergencies or are saving for high-ticket purchases will want to invest more in cash. Investors with greater risk tolerance and longer-term horizons for investing can put more money toward stocks. How much should I invest in cash vs. stocks? In addition to your appetite for risk and the level of returns you are hoping to achieve with your investments, current market conditions can have implications for the ideal breakdown between cash and stocks in your portfolio. In periods of economic growth and low interest rates, stock prices generally climb, and the amount you can earn on cash investments remains limited. However, when interest rates increase and the prospects for economic growth become less certain, as has been the case in 2022, savings accounts and cash equivalents become more attractive. How do I determine the best asset allocation for my portfolio? The asset allocation that works the best for you depends on many factors, including your time frame and your tolerance for risk. Determining the optimal asset allocation strategy involves finding the right mix of investments, from most aggressive to safest, that will earn the returns you need with comfortable levels of risk. For most investors, the ideal mix mostly includes stocks, bonds, and cash or other money market securities. Just as there is no one size fits all strategy, keep in mind that asset allocation is not a one-time decision, and it's important to review your strategy periodically to ensure that it remains in line with your goal. What are cash investments? If you are hoping to preserve your capital and invest with a low level of risk, you may opt for secure investment vehicles such as cash investments. A cash investment is a short-term obligation, usually fewer than 90 days, that provides a return in the form of interest payments. Examples of cash investments include money market accounts, MAS, and certificates of deposits, CD. Market conditions such as high interest rates increase the relative attractiveness of cash investments, and investors may also choose to allocate money temporarily to cash investments while researching other investment products. The bottom line, where the stock market or economy is headed and at what pace will vary based on the investment advice you follow. The current market environment, with interest rates on the rise and doubts about the near-term prospects for economic growth, increases the attractiveness of allocating portions of your portfolio to cash compared with riskier investments in the stock market. However, it is best to avoid overreacting to market volatility by pulling your investments entirely out of stock. The tendency for stocks to gain in value over the long term suggests that there is an advantage in maintaining exposure to the equities market, provided you have the risk tolerance and a long enough investment time frame to weather the ups and downs while waiting for the market to recover. How inflation impacts your savings. What to do when your savings account is losing value. The national average cost of a movie ticket in 2005 was $6.41. By 2019, it was $9.16. In 2022, the average Fandango ticket price is $16.29. That's the work of inflation. The price of a movie ticket, a house, or a semester in college tends to rise over time, sometimes quickly and at other times slowly. That fact is very relevant for your personal savings plan. Key takeaways. The investor is losing money if the inflation rate exceeds the interest earned on a savings or checking account. The Consumer Price Index, CPI, is the most popular way to measure inflation in the United States. Social Security payments are indexed to the CPI, but many believe that is not enough. It is possible to protect savings from inflation by investing in Treasury inflation, protected securities, TIPS, government I-bonds, stocks, and precious metals. How inflation shrinks savings. Let's say you have $100 in a savings account that pays a 1's interest rate. After a year, you will have $101 in your account. But if the rate of inflation is running at 2, you would need $102 to have the same buying power that you started with. You've gained $1, but lost buying power. Anytime your savings don't grow at the same rate as inflation, you will effectively lose money. If you are a retired adult living on your savings, you can't keep up the same standard of living if inflation cuts into your purchasing power with every passing year. That is especially true in the U.S., where medical costs tend to rise at a higher rate than many other expenses. Inflation can hurt well before retirement. Suppose that you are steadily saving money for a specific goal, such as a college fund for your children or a down payment on a home. Your money's purchasing power may decline while you're saving it. What's behind inflation? Inflation occurs as demand for goods and services grows. As the total money supply in an economy rises, there is likely to be more demand from consumers. As more people buy more goods, sellers hike their prices. 3. Inflation is caused by other factors, many of them temporary and limited in their scope. A winter frost can damage the orange crop. That could cause a shortage of oranges and increase their cost. An automaker may be forced to pay more for parts and will pass that increase along to consumers. Measuring inflation. How do you measure the effect of inflation on your savings? The government estimates it for you and publishes the results regularly. The Consumer Price Index, PI, tracks the prices of a variety of consumer goods and services, including transportation, medical care, and housing. The index is published monthly. 4. While the CPI is the most popular way to measure inflation, it continues to be debated. There are also other methods available, such as the Producer Price Index, PI. Inflation in the U.S. Believe it or not, inflation can be too low. In the wake of the 2008 financial crisis, central banks in the US, Japan, and Europe were worried that inflation could go below zero, meaning deflation or falling prices. The US did experience deflation in housing prices lasting several years in many markets. During the worst of the crisis, the Federal Reserve targeted a 2 annual growth in inflation to return the economy to health. The bank initiated various stimulus measures that were intended to boost the economy and encourage job creation, therefore putting more money in consumers' hands. Back in the late 1970s and early 1980s, the Fed fought double-digit rates of inflation and had to deploy monetary tightening measures to combat possible runaway inflation. Economists will probably never stop debating the policies initiated by the Fed during the 1970s and the 2000s. 5. How to safeguard your income. If you are a retired American who gets a Social Security payment, you may see an increase in your monthly check from one year to the next. That happens because the government adjusts the payments based on the cost of living, COLA, as measured by the Consumer Price Index. That increase requires approval by Congress. The COLA for 2023 is 8.7, which adds $146 to the average monthly benefits check. That's the largest increase since 1981. By comparison, a rise of 1.6 was approved for 2020, the same amount as the 2020, the same amount as the 2019 increase. But in 2016, the increase was only 0.36. Those numbers were based on the Consumer Price Index, but advocates for retired Americans argued that was not enough. They pointed out that goods and services used mostly by aging adults, such as healthcare, had larger price increases than the overall index. How to safeguard your savings. The primary way to beat inflation is to invest your savings for a better return than you can get in money market accounts or savings accounts. Investing in virtually anything else inevitably involves more risk than an FDE. But you can choose investments that are appropriate for your risk tolerance. For example, retired people might want to consider Treasury inflation, protected securities. Tips: these securities adjust the interest payouts you get based on changes in the CPI. The principal payment you get back will also be adjusted for inflation. Even if prices go down over the investment period, you will still get back the original principal if you purchased the security when it was first issued. 7. However, government bonds can be a better deal for small investors. Returns on stock investments generally tend to beat inflation. Investors who want to avoid the volatility associated with individual stocks might opt for mutual funds. A passive indexing approach is often best since it does not depend on the stock picking abilities of any particular fund manager. Exchange-traded funds usually have lower fees than other index funds. Investing a portion of savings in precious metals, such as gold or silver, is another way to outrun inflation. Traditionally, people bought gold and silver coins. Today, there are also many precious metals ETFs available for investors. An asset allocation that adds a little bit of gold to a stock portfolio can also produce more consistent returns. 8. The bottom line. Inflation tends to cut into a consumer's purchasing power over time. Fortunately, there are ways of preserving the purchasing power of your savings. That means investing, but keeping your level of risk moderate. How inflation affects your cost of living. Up until very recently, inflation had not been talked about, and for good reason. In 2019, the overall annual rate of inflation in the U.S. was running at 1.80 according to the World Bank. In 2020, the rate was 1.21. In the summer of 2021, however, inflation began to rear its ugly head once again, with U.S. consumer prices recording their largest annualized increases in more than 13 years. 2. From there, inflation has continued to surge. In 2021, overall inflation was 4.7, and it reached a peak of 9.1 in June 2022. The inflation rate started to come down after that due to interest rate hikes by the Fed to combat the soaring inflation, but it still remains high. 4. Still, we've been through worse inflationary times. And there's always talk about inflation and cost of living increases. But what do these terms really mean? And most important, how do they affect your daily life? Key takeaways. Inflation measures the increase in the price of goods and services, or the decrease in the buying power of the dollar. Cost of living measures the change, up or down, of the basic necessities of life like food, housing, and healthcare. Housing prices are affected by many factors, but one of the biggest of them is the cost of borrowing. The difference between inflation and cost of living. People often use the phrases inflation and cost of living as if they were synonymous. They are not the same, although they're closely related. Inflation is the big picture. As the cost of goods and services rises, the buying power of the dollar falls. The inflation rate is often measured by the change in the Consumer Price Index, CPU, a monthly measure by the Bureau of Labor Statistics, BELS, that averages the cost of a basket of goods and services from areas around the country. It reports the result as a percentage rise or drop in CPI. 5. Cost of living has a different focus. This number represents the average cost of an accepted standard of living, including food, housing, transportation, taxes, and healthcare. 6. Cost of living is frequently used to compare minimum income needs in various locations. According to the PayScales calculator, as of Oct. 17, 2022, the cost of living in New York City is $155 higher than the national average. As a comparison, cost of living in Chapel Hill, North Carolina is $80 higher than the national average. 7. 8. Cost of living is a far more difficult number to pin down, and it varies widely among different demographic groups as well as different regions. In 2022, the Social Security Administration raised benefits by 5.9 as a cost of living adjustment, COLA. For 2023, it has been raised by 8.7. 9. Whether your own cost of living goes up or down depends on how you live and where you live. When the going gets expensive, most people feel the effects of cost of living increases in their daily lives. But rising prices hit the middle class hard and the lower paid harder. Higher food, gasoline, and utility costs mean less money for savings or discretionary spending. To compensate, consumers buy less, switch to cheaper substitutes, or look harder for bargains. 8.2. The annual inflation rate for the 12 months ending September 2022 in the U.S. 10. Inflation factors that affect cost of living. Investopedia, Ellen Lindner. The paycheck factor. It's especially difficult to keep up with the rising cost of living when your paycheck isn't growing at a similar rate. According to the Bureau of Labor Statistics, the median weekly earnings for full-time wage earners was $1,070 in the third quarter of 2022. That's an increase of 6.9 from a year earlier compared to the 8.3 increase in the Consumer Price Index for all urban consumers, PU, for the same period. 11. How inflation affects the housing market. You would assume that higher inflation means higher prices for real estate, and that is often the case, at least at the start of a significant spike in inflation. But then things can get complicated. To keep inflation rates under control, the Federal Open Market Committee, FOMC, often steps in and raises the federal funds rate, which is the interest rate charged to other financial institutions using the Federal Reserve Bank. 12. As the cost of home loans goes up, many consumers are squeezed out of the market, leading to a slowdown in home sales. With homes on the market for longer periods, sellers tend to drop their asking price to attract buyers. Lower interest rates help the U.S. housing market make its recovery after the gut punch of the 2007-2008 financial crisis and then again during the COVID-19 pandemic. What is the relationship between inflation and the cost of living? Inflation is the increase in the average price of a basket of goods. Inflation reduces the purchasing power of consumers, meaning that a unit of currency buys less than it did before inflation. 13. The cost of living measures the average cost of the accepted standard of living in a specific area. 14. Inflation can increase the cost of living. What are the three causes of inflation? The three causes of inflation are demand. Pull, when the demand for goods and services is greater than the supply, putting an upward pressure on prices. Cost. Push, when the total supply of goods and services that can be produced falls and built. In inflation, also known as inflation expectations, when workers believe that inflation will continue and demand higher wages to maintain their cost of living. Higher wages means higher costs to businesses, which are passed on to consumers as an increase in prices. 15. Why is inflation so high in 2022? Economists attribute the high inflation in 2022 to shortages due to the supply chain problems that arose from the COVID-19 pandemic. The difficulty in obtaining materials to produce goods due to the supply chain issues from the pandemic caused a shortage in the supply of products, driving prices higher. This was combined with a rapid increase in consumer spending from the pandemic due to federal stimulus checks. Supply could not meet demand. Exasperating these issues, Russia invaded Ukraine, which threw into disarray the supply of gas and food, causing shortages on that front, which also increased prices. The bottom line: inflation and cost of living are related metrics but not identical. While inflation measures the average increase in prices of a basket of goods, cost of living looks at the cost of a certain standard of living, which can change by location. Increases in inflation do increase the overall cost of living. And if wages are not increasing to match the increase in the cost of goods and services, the value of a consumer's dollar will decrease.